I'm John Prasinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, September 12. For U.S. stocks, the bear market lows of June priced in considerable pessimism about inflation, interest rates, and the economy. This pessimism is lifting as Wall Street starts to think that the worst is in the rearview mirror. As I'll explain, though, Europe's woes are considerably worse than America's, largely due to the continent's proximity to the Russia-Ukraine war and its entrenched reliance on Russian energy. The situation in Europe will only deteriorate as winter arrives and the energy crisis in Europe persists. Analysts currently place the likelihood of a recession in the next 12 months at 25% for the U.S. and 50% for the euro area. In the United States, the Consumer Price Index, CPI, rose on a yearly basis to 8.5% in July. The CPI report on September 13 is forecast to show a decline in the yearly inflation rate to 8.0% in August. Euro area annual inflation is expected to be 9.1% in August, up from 8.9% in July. What's more, although interest rates spiked this year due to the Federal Reserve's monetary tightening, they're now below their summer peak. The benchmark 10-year U.S. Treasury note hit 3.5% in June. It currently hovers at 3.3%. It's likely that we've seen the bulk of the rise in rates. After falling more than 20% this year, U.S. equities have embarked on a significant rally. Take a look at the following table. Stocks last week snapped a 3-week losing streak as investors accentuated positives such as strong jobs growth and moderating inflation. The price of crude oil has slipped below $90 per barrel as concerns about an economic slowdown, especially in Europe, weigh on forecasted energy demand. The technology-heavy Nasdaq jumped by more than 4% last week as bargain hunters scooped up beaten-down tech stocks that are poised to thrive once the pandemic and supply chain disruptions are behind us. The table also shows that equities in Europe and other developed countries outside of the United States and Canada, as reflected by the EAFE, remain under pressure. Investments that took the heaviest beating this year were the aggressively risky story stocks, such as cryptocurrencies, meme stocks, special purpose acquisition companies, non-fungible tokens, and other high flyers that initially benefited from excess liquidity and fear of missing out. FOMO. The following chart, which depicts the collapse of Bitcoin's price year to date, tells the grim story. I've consistently warned you about these highly speculative investments such as Bitcoin, and it's not a bad thing that this froth has been removed from the markets. Conversely, during this bear market, value plays and quality dividend payers have held their own. A major bright spot in the U.S. economy has been consumer spending, officially known as personal consumption expenditures. See the following chart. Despite elevated inflation and rising interest rates, the American consumer has kept the purse strings loose. Consumer spending, which accounts for 70% of U.S. gross domestic product, should continue to remain healthy this year as supply chain disruptions wane and delivery times improve. We're starting to witness a shift back towards services spending, especially for dining, leisure, and travel. But inflation continues to exert downward pressure on these sectors. Europe, meanwhile, faces a winter of discontent. The darkest economic clouds on the horizon are in Europe. The Russia-Ukraine war has affected all economies around the world, but Europe has borne the brunt of the pain. The European Union is heavily reliant on Russian oil and gas, and although major EU economies are making progress in weaning themselves away from Russian-supplied energy, the dislocations for households and businesses are severe. Russian President Vladimir Putin has threatened to cut off all energy supplies to Europe in retaliation for Western sanctions. See the following chart. The International Monetary Fund recently calculated the potential economic harm of complete cessation of Russian gas supplies on the economies in the Eurozone. The study shows that over the next 12 months, the European Union would lose 1.8 percentage points of GDP growth compared to the baseline scenario. The most affected countries, such as Germany and Italy, would lose between 2 and more than 4 percentage points. The good news is that EU leaders are showing remarkable solidarity, and they're increasingly confident that their cooperation in stockpiling oil and gas and their shift to alternative sources is weakening Putin's ability to weaponize Russian energy exports. Now let's take a look at the week ahead. In the coming days, these are the key economic data to watch. The New York Fed's 3-year inflation expectations, Monday. The NFIB Small Business Index and Consumer Price Index, Tuesday. The Producer Price Index Final Demand, Wednesday. Initial jobless claims and retail sales, Thursday. And consumer sentiment on Friday. Conditions in the overall U.S. stock market are improving, but we're still witnessing plenty of headwinds, especially overseas. A negative inflation or jobs report this week, or a worsening of the war in Ukraine, could easily trigger another big sell-off. But there are investing methods that generate income regardless of these risks. Consider Rapier's Income Accelerator. Helmed by my colleague, Robert Rapier, this premium publication consistently makes money for its followers, no matter what Mr. Market throws at us. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now. Thanks for watching. And if you have any comments or feedback, please send an email to mailbag@investingdaily.com.